Your IEEE membership means access to insurance products featuring exclusive group rates, flexible benefit options, and portable coverage that stays with you throughout your career. Engineered to help protect your loved ones and your financial security. For more information, go to IEEEinsurance.com.
Good afternoon, everyone, and welcome to our IEEE-USA webinar, Tax Diversify Your Retirement Income. I'm your host, Jonathan Cho. Today's webinar is proudly sponsored by the IEEE Member Group Insurance Program, powered by AMBA, in collaboration with IEEE Women in Engineering. Joining us today are Elise Savello and John DiCalogero from New York Life. Elise Savello is the Vice President, heads up sales and guidance for U.S. Life and Agency. She's responsible for the team of consultants in the Pacific Zone and for implementing strategies to promote protection solutions that support our agents in the field. Elise first joined New York Life Insurance Company in 1996 as Director of Annuity Sales, moving on to become the Regional Manager of the Pacific Zone in 2001, Corporate Vice President and National Sales Manager for the Investment Product Consultant Team in 2009, and Head of Sales and Guidance for the Pacific Zone in 2023, overseeing sales and consultants for all protection solutions. Elise has presented at numerous council meetings, industry meetings, the $1 Million Roundtable, the National Association of Insurance and Financial Advisors, and hundreds of public workshops to promote retirement strategies and opportunities. John DiCalogero joined New York Life in 2005 as an agent with the Long Island General Office. After achieving executive council status and leading his class in Life Premium, he moved to the Life Sales Desk in 2007, collaborating with agents nationwide. In 2009, he became a life product consultant for the South Central Zone, and in 2012, he was honored as a National Life Product Consultant of the Year. In 2015, John became the National Business Solutions Sales Officer, leading consultants to support worksite sales nationwide, achieving nearly 70% growth and expanding the portfolio to include group term and disability. In 2020, he was promoted to National Life Sales Officer, overseeing Zone Life Sales Officers and Life Product Consultants across the country. Since January 2023, John has served as the Head of Sales and Guidance responsible for product consultants and sales growth in all products for the Northeast Zone. Without further ado, I'll now pass it off to our first presenter. Welcome, Elise. We're very excited for what you have in store for our audience today.
Thank you, Jonathan. It is great to be here with all of you and to discuss this very important topic of retirement. You know, a lot has happened over the last several years when it comes to options and solutions for retirement. So hopefully you gain some new insight today from myself and John. We're going to talk about the power of tax diversification to help protect those who matter the most to you and to potentially lower your tax burden in the future, which I'm sure all of you, most of you would love to do out there. You know, John and I present this type of information to individuals all the time. As Jonathan mentioned, we represent New York Life. You may have heard about New York Life. You may know New York Life. Let me share with you a little bit about our company. We were founded in 1845 and have remained a mutual company serving our policyholders. We are the largest mutual life insurance company in the United States. And in fact, we rank number 78 on the Fortune 500 list. We've got, as you see here on the screen, the highest possible financial strength ratings currently awarded to any U.S. Life insurer with $32 billion of surplus. Now, as a mutual company, you've heard me mention that now a couple times. A mutual company, we are fully aligned with our policy owners, not with outside investors or Wall Street. So that allows us to take a long-term and lifelong approach with our clients and policyholders, which includes sharing in the success with eligible participating policyholders through non-guaranteed dividends. So as an example, last year, we declared the largest dividend to eligible participating policyholders in our 178-year history, totaling $2.2 billion. And why I bring this up as well is when it comes to planning, especially for long-term like retirement, it's critically important to consider the company that you're investing with. Today, retirement is such an important topic, and 33% of today's workers are less confident that they'll have enough money to retire comfortably. It's so critical to even just take a step back. You've heard that old saying of people who say, Americans spend more time planning a vacation than they do their actual retirement. So, through this webinar today, I ask that you just take a step back and think about where you've invested money and what your goals and objectives are for that money. I know we've got a range of individuals who are on the call with us today, many women who may be 5 years, 10 years, even 30 years out from retirement. Where you've invested your money today, does that match up with what your ultimate goals are for that money? A really powerful question that I would ask you is, are you paying taxes on money that you're not using, especially if it's for retirement purposes? Or are you investing long-term money in short-term assets? John and I will discuss different strategies to consider, especially when it comes to retirement. And look, we look at today's retirees, and retirees today expect so much more out of retirement. Think about your parents or grandparents on what retirement looked like for them. It was much more simple. It might have been playing cards, watching TV, simple things that made up for a complete retirement. And today, retirees expect so much more with regards to being more active, traveling, playing golf, spending more time with grandkids. What do you want your retirement to look like? Because it's also important to consider some of the challenges that we face today. There are fewer defined benefit plans than there were even just 10, 15 years ago. I saw a recent stat that it's less than 20% of companies today provide a true defined benefit pension plan. We also know that Social Security may replace a smaller portion of retirement income in retirement. And of course, market uncertainty. So we know that markets go up, markets go down, but the type of market while you're in retirement matters, and you'll see why. And we'll talk about what sequence of return risk actually means and some considerations there. And then lastly, most retirees aren't sure how to efficiently generate retirement income. There's more options that are available today than there ever have been on how to generate retirement income, and not only retirement income for your guaranteed living expenses, but even for your discretionary assets and income. So let's talk about risks to consider, not only in your accumulation phase, but where we're going to spend time is especially in that retirement phase as we focus on retirement. So pre-retirees today, we know that the biggest risks we face are market volatility, healthcare costs, employment risk, and even taxes. But you see, as we move to the retirement phase, there's a whole new set of risks that you may not consider. Longevity risk most definitely comes into play. Withdrawal rate risk, inflation risk, and then what I also mentioned with sequence of return risk. And we'll spend some time on each of these. So longevity risk. We know today that people are living longer, but what does that actually mean? So let me share with you a recent study. The blue line represents men who are 65 years old today. The orange line, it's for us women who are 65 years old today. And the green line are for those of you who are married or have a significant other. So as a 65-year-old, let me start with the blue line. What this shows today is that men have a 50% probability of living at least to the age of 87. Said another way, men have a 50% chance of living beyond the age of 87. The orange line, women. Today, a 65-year-old woman has a 50% probability of living at least to the age of 89. And for those of you who have a significant other or are married, 50% probability that one of the two spouses are going to live to at least the age of 92. That is longevity today. And this is the hardest risk to manage in retirement. So think about that. If you knew exactly when you're going to die, the exact age that you're going to pass away, it'd be so much easier to manage your assets. But this is the unknown, and this is the overarching risk that impacts all the other risks in retirement, is not knowing how long we're going to live. And I know that many of you on this call today could think of people that you know that are well into their 90s and even over the age of 100. This is a real risk today that impacts each and every one of us. Secondly, withdrawal rate risk. Many factors come into what that safe withdrawal rate risk is. Historically, it's been a 4% withdrawal rate that you could take out safely without depleting your portfolio and assets. But due to the interest rate environment, you look at what academic professors have said, and that numbers actually come down between 2 to 3% as a safe withdrawal rate risk. Inflation risk. Well, we knew this well during the pandemic and over the last couple of years. This is historical inflation rates and the impact on goods that we use every single day. And you might not have realized how much the cost of these goods have actually increased. Take something simple as a loaf of bread. Back in 1990, would you believe that it was 69 cents? And today, average is over $2. That's nearly a 3% inflation on just a loaf of bread. Coffee, 2% inflation risk. Gas, and I don't know about you, but it's showing that the average gas price of $3.22. I know that in many areas across the country, it's actually in the range of $4, $4.50. Inflation is real, and you have to consider that when you're planning for retirement. All right, I'm going to spend a little bit of time on this because this is an important one, and this is probably a risk that most Americans are not familiar with. It is called the sequence of return risk. And the reason why working individuals today do not even consider or are not familiar with sequence of return risk is because it doesn't apply during our working years. So what is the definition of sequence of return risk? It is the order of returns that you earn on your money. You see in the chart here, back to 2000, the investment returns that you see in the third column are the actual returns of the S&P 500 with the correlated year that you see on the far left. So in 2000, S&P 500 returned negative 9.1%. If you invested $100,000, your balance would have dropped down to $90,900. We are looking at the actual S&P 500 returns, investing $100,000 over a 24-year period. So the ending balance, should you have stayed invested, would have been $510,842. That's an average return, as you see there, again, just staying invested in the S&P 500. If we were to flip these returns, in other words, what you earned in 2023, 22, 21, 20 is in the early years, you'll see that the order of returns makes no difference. It is still an 8.7% average rate of return, invest in $100,000. Order of returns, the ending balance is $510,842. The order of returns and the sequence of returns does not matter in our working years. But hopefully something that is really eye-opening is this has a significant impact when it comes to retirement. So what happens when you start taking money out of your portfolio? Similar example, S&P 500 returns from 2000 to 2023. You invest $100,000. The only difference is now you're starting to take withdrawals. You start taking $4,000 a year, and it increases with inflation. So after a 24-year period, you take out $137,706. The average rate of return, as we saw from the earlier chart, 8.7%. your ending balance is $21,740. This is simply math, right? This is not subjective. It's not my opinion. It is simply math. By putting $100,000 in, taking out 4% S&P 500 actual returns. Now, this is what's really eye-opening. What happens if I flip the returns? So what you earned in 2023, 22, 21 is actually in the early years. And instead of experiencing a down market like you see here in the first 3 years, you only experience a down market 1 out of those 3 years because I'm going to flip the returns. All right. That's the blue chart. Invest in $100,000, S&P 500 returns, simply flipped, taking out 4% per year. So still average return of 8.7, still taking out $137,706 only. Look at the ending balance. Now, instead of ending the balance with $21,740, your ending balance is $297,929. Sequence of return risk is real. This again is purely putting a math equation in. It's not investing in anything other than the S&P 500 and flipping the returns, but this is a real risk that retirees face today. Now, why is that important? Well, it's really important when you get to retirement because you don't know what type of market you're going to retire in. And as we saw in the pink chart on the left-hand side, if you happen to retire in a down market, that can have a significant impact on your overall retirement and the retirement income. Sources of retirement income today, we talked about pensions, which are becoming obsolete. Social Security may simply not be enough, which puts more importance and emphasis on personal assets and how you invest those personal assets for retirement as a complement to the other sources that you have. And it's important to balance both that growth and security. Personal assets are critical. In fact, most people have more questions than answers when it comes to preparing for retirement. In your personal situations, just think about how much will I need? How much will I have? And how much do I need to cover the shortfall to cover my expenses? And for your personal savings, considering where you're investing your money and how is that impacted by taxes is critical today, and especially as you lead up not only to retirement, but even in retirement. So let me turn it to John, who's going to talk about some different strategies to consider, some different options that even give you flexibility. John?
Awesome. Thanks, Elise. And I appreciate the opportunity to get with you all today. And it's good to talk about kind of the longevity risk, what's out there, what the current market is doing, how inflation can affect you. And before we get deeper into taxes and how some upcoming legislation changes might have some effect on where we are today, it's going to take a quick step back and go over just the quick benefits that you have. Now, through the benefits, through the organization, you have 2 offerings. And these offerings are unbelievable baseline opportunities for you to really get the protection you need, as well as making sure that you have the peace of mind knowing that the work you're doing today will also make sure it's maintained with your family in case anything were to happen to you. Now, through the organization, you do have an unbelievable life insurance solution. You have term insurance that's layered into different types of coverage, either an annual renewable, 10-year level, 20 to 65, or joint term. This just makes sure you have that protection needed. So during your working years, if you were in a situation where something were to happen to you, that's covered. Now, long-term disability insurance, I will say, probably is one of the most important foundational protections that you can have. This is your paycheck protection. You are significantly more likely to become disabled at the workplace, not just due to an injury, but in most cases due to a sickness or illness, than you are to pass away. 1 in 4 working Americans do actually face a long-term disability insurance incident in their working years. But this is meant just to, as I mentioned before, replace that income to give you a flat dollar amount or a certain percentage of salary. There are elimination periods that you get to flexibly choose, whether it's 30 days or 360 days. You can choose your benefit period that you want to have 2 years covered or up to your Social Security age, or choose whether it's own occupation, any occupation. So the benefits currently offered right now are unbelievable. And for Elise and I to come here and talk about just different ways to complement, to work, to make sure that you are really capitalizing on the benefits offered is truly a pleasure. But there's that one key question. As Elise talked about longevity, she talked about where we currently are with the current economic environment. It's also, have you thought about how the effects of taxes on your future retirement income can affect you? We all think that, okay, here's our plan, here's what we're looking for, here's how things can look great going forward. But what if there are certain changes? And if we could look at historically what taxes have been, where we are today, and where things seem to be going, maybe there's an opportunity to not course correct, I want to say, but maybe there's an opportunity to think of maybe a different strategy to diversify that thought process, to diversify where your money is, to make sure you're getting everything you possibly can. So let's take a look at where we currently are. Right now, believe it or not, I know with the current election going on, we're going to hear a lot about taxes. You hear about what could be proposed, but we actually are at a historical low level right now when it comes to federal taxes. Believe it or not, we were in a significant higher tax bracket, up to almost 70% federal tax rate in the past. Just think about that for a second. When we talk about where tax rates are at the top level now, as opposed to in the past, there's a significant portion of your time that you actually spent essentially working for the federal government. But where we currently are right now, we know we're in a lower environment. With what's happening with the current economy, we have a good feeling that there's potential that in the future, tax rates can go up. And we're starting to see that as some legislation changes are happening. When we look at kind of where things were to where they are now, there are reasons and there are programs that we set forth to make sure you can put money aside and retire comfortably. If you look back in this timeline here from 1979 to 1980s, you see the top federal tax bracket, as I mentioned before, was at 70%, while today it's just under 40%. So think about this. During that time, we knew that was going to be tough to defer money for retirement. So that's why great qualified plans came out, 401ks, IRAs, defined contribution plans. These are plans that were put in place that if something were to happen, like tax rates were to go down, we can defer taxes in a higher environment to then in the future, if tax rates went down, we can retire, pull money out, and pay taxes in a lower bracket. So when you look at those individuals who put money away in 1979, that maybe were in that top bracket, if they deferred their money today, didn't pay taxes on it, and then retired in 2023 in the top bracket, that went from saving a 40% payment or 40% tax burden to now 37%. So that was actually a perfect plan that you deferred in the higher bracket, and now you look at it in the lower bracket is when you're pulling money out in retirement age. But now we're at that lower level. So now there's a concern or thought that maybe we should start thinking about other opportunities to keep putting money to my qualified plan, but also maybe pay tax on the money today, seeing that tax rates are going up. Now, there's the Tax Jobs and Act of 2017 will be sunsetting by the end of this year, the end of next year. And when that happens, there is certain legislation that's going to come into play. It's going to change some of the things that we're going to see. One of them is we're going to see some middle market tax rates increase. A married couple making $160,000 a year currently is taxed at a 22% federal tax rate. With what the current act is enacting, is that 22% could actually increase to 28%. Now, you might think, oh, it's just a 6% increase, but that actually is a close to 30% increase in your federal tax bracket, the federal tax payments you have every single year. So that can be pretty substantial. So this isn't just, as you might hear, for the wealthy or for the lower class, but the middle class, with what's being proposed right now, could potentially see tax rates going up. So maybe it makes sense to start putting a plan together to defer some of those taxes for the future. And that's when we think about what makes sense. How much retirement income do you need? How much do you think you're going to get to use? But also, more importantly, where do you want your money and where do you think it makes sense? So we have 3 buckets of money that I want to talk to you about today. One, we have our taxable money. That's your 1099 every single year that you're getting taxed on. You have your tax deferred money, just like those qualified plans that you put aside that make sure that you're not paying tax on today, you're getting your deductions, so you get taxed in a lower bracket today. And then there's the tax-free income that you pay tax on today, put it into a vehicle that'll make sure that you can have that can grow and you can pull money out down the road. And you won't have to worry about that tax bill. And really, when we look at these 3 buckets, think about yourself. Think about yourself and think about where you are putting your assets and what might make the most sense. Let's talk about taxable first. As I mentioned, you're getting a 1099 every year. That's CDs, that's savings accounts, investment accounts, real estate, business income, mutual funds. Every single year when you file your taxes, you're paying money. So when that grows, the government's taking a part of that as taxable income. So that's what you have to be reporting every single year. The second part here is that tax deferred, as I mentioned before. These are those 401ks, IRA, annuities, and just other compensation plans you might have. Putting money away today to defer taxes for the future. Then there's that tax-free bucket. And this is becoming that hot topic because as we know that with tax rates, with where they may potentially go, with what we're seeing happen, especially with the last tax rates that increased, we know that maybe there's an opportunity for us to put it to a vehicle that can grow tax-free and we can pull money out tax-free as well. That includes those Roth IRAs, 529 plans, municipal bonds, cash value life insurance is one of the other options. So what I would say here is think about yourself and think about your family. Think about where that money is. What percentage of your money is sitting in the taxable? What percentage is sitting in tax deferred? And what percentage is sitting in tax free? The majority of clients that, we work with agents all the time, Elise and I, the majority of clients that we sit with our agents, I'll tell you, the majority have the bulk of their money sitting in their tax deferred bucket, which is great. It's great to have money that's meant for retirement, meant for down the road. But what's the preparation we've had? And what maybe shifts can we make? And maybe there's opportunities that the money sitting in the taxable bucket, we can start finding out creative ways to start putting it into that tax-free income bucket to make sure that that money won't be taxed again. So everyone wants a perfect tax plan. I mentioned contributions tax deductible, I mentioned accumulations, tax deferred, distribution tax-free. If you can get all three of those, that's the absolute perfect plan. The only problem is that plan doesn't exist. But the good news is 2 out of 3 do exist. So thinking about your situation, thinking about people that what might make sense? What 2 out of the 3 are most important? And maybe if you were to take a step back and think, if you were to rank these 3, what's most important to what's least important? And what planning have you currently done? And how does that coincide with what you feel is critical to your future for pulling out money for retirement? And when we look at the vehicles that we traditionally look at when we look at these planning, again, diversifying the mix to make sure you have the best of everything together. We have traditional IRAs, which again are the deductions are tax deductible. Accumulations are tax deferred, but when you pull money out, you're taxed, as well as if you pull money out before 59.5. With all qualified plans, you also have a 10% penalty. 401k, very similar to those plans. Now, Roth IRA, while you don't get the deduction because you're paying with after-tax dollars, you do get tax-deferred accumulation and tax-free distribution. Pension plans, very similar, is tax deductible contributions and tax-deferred accumulation, but distributions are taxable. Municipal bonds, just like Roth IRAs, don't have contributions that are tax deductible because you're using after-tax dollars, but it will have tax-deferred accumulation and tax-free income. You got GIF plans, you have profit-sharing plans, very similar that you're getting your deductions today, accumulate tax-free, but the money will be counted as taxable income. And there's that unconventional one. There's something that's a bit different. It's cash value life insurance. You have life insurance plans to your organization, but is there a way that we can leverage cash value life insurance that does work similar to a Roth IRA, that does work similar to tax-free municipal bonds, that with after-tax dollars, we can put it to a vehicle that can provide protection, that can also grow cash, that'll be tax deferred, that can either be through a guarantee basis through our whole life insurance coverage, or can be in separate accounts that can have more market exposure like our variable universal life. That you can also pull out in the future that also provides tax-free income. So just a very unique way of thinking about this, but we have lots of vehicles that one can fill up that tax now bucket. You have lots of vehicles that fill up that tax later bucket, and lots of vehicles that fill up that tax never bucket. So the diversification of these vehicles here that might make the most sense are those things that you want to start thinking about. But when it comes to that non-traditional solution, we talked a little bit about cash value life insurance as one of those options. It's interesting because it's not just about the protection. It's also about that accumulation. With those after-tax dollars, you can use these funds that can give you a cash value that accumulates on a tax-deferred basis. There can be a guarantee method to it, so you can get guaranteed cash. And also, as Elise mentioned, we are the largest mutual life insurance in the country, which means we are not a publicly traded organization. So when you own a whole life contract through New York Life, you essentially own part of New York Life, which then qualifies you for dividends, which we've paid out over $2 billion in dividends to our policyholders in 2023. So we are an organization that is policyholder first. That's all about making sure that we protect the individual, but also as New York Life being a mutual company, we give back to our policyholders in those forms of dividends. So there's a lot of ways, we can help, hit to our goals. The big thing is here is one, you want to be able to live to accumulate enough money, right? And the protection of permanent coverage will ensure that. So if something were to happen to you, at least that legacy benefit will be passed on to your heirs to make sure you'll have sufficient resources to help fund. And then more importantly, one of the great things about cash value life insurance as an alternative for that tax never bucket, if you become disabled, we have an opportunity with our disability waiver premium that if you become disabled and can no longer attend work, what will happen is we kick in a rider that we'll pay the premiums for you that will keep the policy in force. We'll keep putting money into cash value that will grow tax deferred and you can pull out tax free. So unlike some qualified plans that if you become disabled, there goes the retirement funding and you have to basically let things grow to where they are. With cash value life insurance, if you were to become disabled during the workplace, that this will also waive those premiums and accumulate over time. It'll give you a plan that will be self-completing. So whether you live, you have cash value, whether you were to pass away, the legacy goes on to your heirs, or become disabled, we can waive those premiums. So before I pass it back to Elise, let me show you just an example of kind of tax diversification in real time. This works with any of those vehicles that we talked about for the after-tax dollars into the tax-free bucket. Traditionally, as I mentioned before, in that 1979 to 1980, when tax rates were high, a lot of individuals were putting money into those qualified plans to defer taxes today, thinking tax rates would go down. That was the perfect plan. But in today's world, if we were to just put all of our money into qualified plans and then retire and tax rates never changed, and you want to pull money out, I'm 70 years old, I want to pull $100,000 out. Right now, $100,000 in a single tax rate would be about a 22% tax rate, which I would be charged around $22,000 in taxes and left with $78,000 for retirement. So for every $100,000 I pull out, for the first $100,000 I pull out, 22% I'll have to give back as taxes for that money because I deferred that money. Now with proper diversification, and the idea is saying keep putting money into qualified plans, but maybe there's an opportunity to take some of those assets and put it into a vehicle that can grow tax deferred and pull money out tax free. And as an example, using cash value life insurance here, if we were to do 50 out of your qualified plan and distribution of 50 out of cash value life insurance, what would happen is we would then lower that tax burden pretty significantly. Now that 50,000, 100% taxable, but that will only put you at a 12% bracket because you're pulling out less income, not the 22% out of the 100,000. So it puts you into a lower tax bracket. And the 50,000 of cash value, pull that money out, that's tax free. So instead of paying a 22% tax on a $100,000 distribution by diversifying and using the 3-bucket strategy, that's lowering your tax bill by a significant amount, only paying $6,000, and you're left with $94,000 of after-tax income. So through diversification to your retirement and diversifying your taxation from where you are today, that could be an $18,000 a year swing in retirement. Now, one of the things I always hear is, well, understood, but when I retire, I'll want to take less income and I'll retire in a lower bracket. It's common, and that's the strategy that we want to make sure that when you're retired, you want to pay less taxes. You're not working. But we don't know where tax rates are going. And as we saw with tax rates going down since 1979, and we see tax rates start to slowly go up, if we were to be in a higher tax bracket when you retire, a program that lets you diversify the kind of money you can pull out, whether it be qualified or non-qualified in the tax-free bucket, lets you ensure you'll be in the lower bracket. So if that 50,000 at 12% 20 years from now is 20%, maybe instead you pull out 25,000 out of your qualified plan and 75 out of the cash value life insurance to balance it out, to make sure you're having the lowest possible tax bracket and you can control the tax bracket that you're in And that's what that tax-free bucket does. So kind of coming in full circle here, we talked about some of the benefits of some of those vehicles. And at New York Life, being the #1 life insurance mutual company in the country, if not the world, we do have, the Cadillac product of whole life insurance. So when you're thinking about protection and thinking about accumulation, thinking about distribution, that's how everything comes full circle. Having a guaranteed death benefit, guaranteed never to have any premium increases on your product, guaranteed cash value, having tax-deferred growth, having a tax-free death benefit, having tax-free distributions, as well as qualifying for dividends being a mutual company, and based on state location being creditor protected, this can make sure that is a truly self-completing plan that puts you and your family in the best position to retire, as comfortably as you can, while also giving you peace of mind during your working years. If something were to happen, your family's protected. So again, we talked about a lot of things. We talked about the longevity of outliving income. We talked about the importance of the sequence of returns. We talked about taxes, where they currently are, where things are moving, and also some strategies to avoid potential maybe increases or some potential hiccups that could happen. And with that, Elise, I want to pass it back to you because I know we have just a few more things to go over before we'll open it up for questions.
Thanks, John. Such powerful ideas. And I think that's really what's eye-opening, is that it's not one solution to meet your retirement goals and objectives. There's multiple ways to solve for that, and especially through tax diversification and the strategies that John has reviewed with us today. So I ask you and to ask yourselves, what is your protection plan? And are you addressing your needs and objectives for your future retirement? Could you take advantage of tax diversification? Hopefully, you've learned some new ideas and strategies to help you become even more prepared for your future today. And we're here to support and answer any questions that you have. But for each and every one of you, you've got different goals and objectives that you're trying to achieve for retirement. Your retirement is your personal plan. So thinking about what your goals are, prioritizing your goals, developing a strategy and taking action. And then really important is to update and review your progress, because we know that so much happens on a year-to-year basis. It's important to do this on an annual basis, to just take a step back, review what your goals and objectives are with the money that you're investing, and to just make sure that it aligns with what you're trying to achieve. We know many investors wait 3-5 years, sometimes longer, before they actually review their plans, and retirement is upon us, right? So we recommend at least an annual review, or even getting a second opinion to ensure that you're on track with meeting your goals, especially when it comes to retirement. So with that, Jonathan, I'll turn it back over to you.
Fantastic, Elise and John. Thank you so much. So folks, we are at the Q&A portion of the webinar. Please post your questions in the comments and live chat section, and we'll load them onto the stream for our presenters to answer. So John and Elise, before we go into our audience, we did receive a couple comments from our audience members. Before we go into that, I did have some questions of my own that I wanted to ask. These are some common questions that we've received from registrants in the past regarding financial literacy topics. So the first question, Elise, you had mentioned earlier in the presentation, towards the beginning of the presentation, how factors like market uncertainty may be, is a big factor in regards to retirement income and how much one should save. And we know when it comes to uncertainty, everyone gets a little bit, concerned. So my question is, how do you help clients avoid emotional decision making during market downturns, or I guess just any sort of economic, situation?
So I would say, first of all, Jonathan, it starts with what the goals of that money are, right? Investing in the market, and we know there's market volatility, is really designed for people who are investing for a longer term period of time. And we know that the markets go up and the markets go down. It is not designed for short-term investing. There's ways to diversify portfolios and ways to allocate money between fixed income and equities to help balance out that risk and volatility. But it comes to what the individual objectives and risk tolerance are to determine what is the right portfolio allocation to manage that risk.
Gotcha. Thank you. John, anything to add on to that?
No, I think Elise nailed it, honestly.
Oh, I think we might have lost connect. Oh, sorry about that. I think I just lost connection for a bit. Can you both hear me?
Yep, you're back.
Yes.
Okay, perfect. Okay, no problem. Thank you both. So my next question, and you may have gone a little bit into this during the presentation as well, but a common question that we received: what strategies can I use to minimize taxes when withdrawing from my retirement account? And if, feel free to, either one of you, if you have any insight, feel free to jump in.
So, I mean, I'll jump in with just a couple ideas, and John, feel free to add to this. An example that John shared of tax diversifying retirement income through cash value life insurance is one way to manage and actually reduce some of the taxes that you pay. We do have investors who use cash value life insurance as a supplement to retirement, and that income does come out tax free. If designed appropriately. So that's one way that you can minimize taxes in retirement. The second way that I would put out to think about is what's called income annuities. Income annuities are issued through insurance companies. They are designed specifically for retirement income. And when you invest after tax dollars into a vehicle like that, number one, it provides you income for life, for the rest of your life. And secondly, that income comes out with a portion of your principal and a portion of interest. So you only pay taxes on the interest portion. Unlike other investments, other vehicles where it's all interest coming out first, or in the case of qualified plans like an IRA, 401k, SEP, it's qualified where taxes have never been paid. So 100% of the withdrawals coming out would be fully taxable. So complementing those retirement vehicles like IRAs, 401ks with other vehicles that mention like income annuities or cash value life insurance would be a strategy to consider to, help to reduce taxes or even spread out the taxation rather than putting it all in one vehicle.
Yeah, and what I'll say is when Elise started, she talked a little about diversification and making sure that you have the right vehicles in place. I mean, it is, when you talk about minimizing taxes when you're withdrawing in retirement, it's all about, again, that diversification of where is each money today? What is it doing? What's the purpose of it? And also, when do you plan on using it? What's the distribution strategy? So when we talk about those diversifications, about your retirement assets, if tax rates were to go up to minimize taxes, you'd want to access that tax-free bucket to minimize those potential taxes that could happen through your qualified plans. Another thing also is in the funding period. The funding period is always important because for those who are pre-retiree, you have 15, 20 years before you retire. It's all about providing yourself also the best opportunity to have the most amount of income. And the thing that's interesting and unique about cash value life insurance, specifically whole life, we like to consider it kind of that spare tire of your portfolio. It's that part of fixed asset that's growing, but it's also a great buffer asset. So if you're putting money in or you're taking money out, there's an opportunity to pull money out during the down market time. Because if you're pulling money out in your qualified plans, all of a sudden you hit a rough year in the market, continue to pull out those qualified plans when the market's down. It could result in significant less income when that buffer asset can come in that you can take out that tax-free income to make sure you're not pulling out the down year, giving that account the opportunity to recover. And then the next year going back to the qualified plan when it recovers and not losing potential future income.
Right, fantastic.
Jonathan, just to add to what John mentioned really quick, that strategy that John just described using cash value life insurance as a buffer asset would address the sequence of return risk that we discussed earlier, where rather than continuing to take money out of a portfolio, an investment portfolio as an example, during those down years, you would take it out of the cash value life insurance, enabling the portfolio to recover. So that is a diversification strategy to consider for retirement income.
Fantastic. Thank you so much to both of you. Yeah, I mean, always having a buffer is really nice, especially because we don't know when we might need that money. No one wants to save the bare minimum and have to use that bare minimum and end up in a, negative. So on to our audience member questions. So this first one isn't really so much of a question, but more of, I guess, a statement. So our audience member says, health savings accounts cover all three: tax deductible contributions, tax deferred free accumulation, and tax free when withdrawn for medical expenses. Since medical will be a major cost in retirement, it's a good option for saving for your future medical expenses. Audience member goes on to also continue. I think that's the only savings plan that hits all three. Do either of you have any comments about that?
Yeah, no, it's a very good comment. You know, it is geared towards medical expenses, so that is something that's just for those medical expenses. And what we're talking about, the 2 to 3, is for retirement assets and also flexibility to pay for whatever with. That's the difference. But I would say HSA plans, very good plans. You know, very good plans to be involved in making sure that you're putting money aside today to pay for those future medical expenses that could incur. So when offered, absolutely 100% in that is a very strong part of a foundational part of a portfolio and for your financial plan.
Yeah, I agree, John.
Fantastic, thank you. And thank you to our audience member for your great statement. This next one, one of our audience members, and I think this is regarding the benefits of tax diversification slide from earlier. Audience member says the retirement income comparison is somewhat misleading as it does not account for the current taxes that need to be paid for the $50,000 tax-free investment. Any comments regarding that?
Yeah, I mean, it's a good statement. It's again after tax dollars. So we have chosen to pay taxes later as opposed to today, and that after tax in today's environment, as we're anticipating, again, while we can't predict, we're anticipating that after tax today will be lower than those future taxes and where tax rates can go. We just showed a level playing field there, just showing what the current tax rate is today. That, you know, we're not sure the example of what the individual is making, but if tax rates are to increase, then we'd see, yes, that would be offset quite a bit based upon where the tax situation would be.
Thank you, and thank you to our audience member for your statement as well and comment. This next question from our audience member Arun. So how can I reach you after the presentation? So just to start off, Arun, I did include a link to the New York Life website. In case you need it in the comments section. But John and Lisa, in case Arun wants to reach out directly to either of you, is there a way to reach you, a better way to reach you?
Yeah, I believe that there's a feedback form, right, Jonathan, that's going to be sent out to members as well, that we are happy to follow up with any type of questions that do come from the audience here to answer it after the workshop today.
Thank you. And yes, so Arun, we will be sending, as Elise mentioned, we will be sending a feedback form to our registrants afterwards. So it will include all the information you need. If you don't receive one, reach out to us at IEEE-USA, and we'd be happy to help you. This next question, Elise and John, from our audience member Bill, can cash value life insurance be purchased after the age of 65 with either tax deferred or already taxed income?
Yeah, it's absolutely. I mean, the younger you are, the sooner you are, the better the performance will be. But it also is at that time, what is the goal of it? Is the goal to get as much cash as possible? Is the goal for protection, for legacy benefit? That's when we have to figure out what the actual need is and what we're looking to accomplish. And we might have a different vehicle that provides more permanent coverage, or something that can give a little more, I guess, a little more cash into it that can give you more growth right away.
Yeah. And one additional comment that I would add to what John mentioned is the younger you are, typically the healthier you are with life insurance. Just remember the insurability is taken into consideration. So someone who's 35 years old versus 65 years old, we do have people who, purchase cash value life insurance at the age of 65, but health will still be a consideration. And in many times, individuals who purchase it at the age of 65, it's for different purposes. It could be legacy planning. It could be, to estate planning. So it just depends on what your goals are. But to answer your question, Bill, the answer is yes. You could purchase it at 65.
Fantastic. Thank you. And thank you, Bill, for your question. This next question, our audience member asks, are there ideal ages for starting these plans? I realize sooner is best, but is there a point when it is too late given the age?
Well, Elise, you want to take this one?
Yeah, I don't think that it's too late. I mean, I would probably answer this in the same way that I just answered the previous question, which is the sooner the better. to enable you the ability to build up the cash value in your account, time is on your side. So I would say the sooner the better, but it's never too late to consider this as a way to diversify your other assets.
Thank you, Elise, and thank you to our audience member for your question. Our audience member Larry asks, do you have any thoughts on IRA to Roth conversions when withdrawing from retirement accounts?
So a couple thoughts on that is just remember when you do convert, you've got to pay taxes on that. Broadly, I would say that this is a key follow-up. It depends on the individual because every situation is different on whether or not it makes sense for the conversion. It depends on your current tax bracket. There are different strategies where you could do it over time. We've got other people who just do it as a lump sum. So there's multiple ways that I would answer this question, but we know that the benefit of Roth IRAs is the tax-free distribution aspect, which provides a tremendous value as a complement to other qualified plans that you may have.
Nothing.
That's thank you. This next question, Elise and John, Abraham, asks, what advantage does the cash value life insurance give compared to Roth IRA apart from contribution limits?
No, it's a great question. First, you mentioned contribution limits, which is key. Being able to have more or put more into a vehicle and not be told you have to stop at a certain level. If you get better, you grow, your career advances, you want to put more money into a vehicle that will provide that income. That with cash value, you can do that. With Roth, you are capped at a certain limit of how much you can put in. The other is also just the death benefit on top of there. It's a very important feature of cash value life insurance. And not only are you funding a vehicle that can grow, that will provide tax-deferred growth and tax-free income similar to the Roth, but if something were to happen to you in those working years or before you retire, that provides a tax-free legacy life insurance death benefit that will go back to your heirs for them to then use as income, for them to reinvest. So it's not just about that. It's that idea of having that self-completing plan that makes sure if you become disabled and you can't put money into your Roth, guess what? Cash value life insurance will do it. If you live and want to access money anytime you want, there's cash inside the contract. You want to buy a new house or vacation home, use it as a down payment. You can do that with the cash value life insurance. And also, if you were to become disabled, we'll make sure to waive those premiums to make sure we will still continue to fund to provide that cash value benefit and that legacy benefit that will go to your heirs. So those are some of the big benefits. Those are some of the big differences. But the feature of contributions is also one that you said that you understand. Is very important, that this is also a product and a contract that will grow with you as you grow in your career.
Thanks for the insight, John. And thank you, Abraham, for the question. This next question, how may one best estimate expected retirement expenses?
This is definitely an individual question that or answer that would vary. It depends on what your living expenses are. It depends on how much guaranteed income you expect. If you are expecting to get, pension income, Social Security is going to be dependent upon how many years you've worked, whether or not you're married. And those are things that are all taken into account as far as how much you can expect your expenses to be in retirement. So, Les, I would say that it's an individual situation that does require further evaluation on a personal level, because we would look at how much are you currently spending, what are your expected retirement expenses in the future, how much are you getting in guaranteed income, and how much you need in your shortfall to fill the gap.
Yeah, and one thing I'll add to that also is, as Elise mentioned, which is 100% true, it's all individually based. There's no one cut answer. But that's what's the great thing about the follow-up for this seminar today. If you want to go deeper in that and you want to know what's my specific retirement, kind of my retirement plan, what I expect with my current expenses today, what they might look like tomorrow, what needs do I have? And that's when we can have that follow-up with you all and give you a retirement analysis and an assessment to see where you currently are and where we think things will need to be in the future.
Thanks, Elise and John, and let's hope that answered your question. So folks, we are approaching the end of the hour. We have time for a few more questions. Elise and John, this next question, Randy asks, for pre-retirees, I would always hear, don't let the tax tail wag the dog. First, I'd like to hear if either of you have ever heard that quote before, but now I'm hearing a lot of focus on tax strategies for retirees. Can you clarify why there's such a focus on taxes for retirees?
My comment to that would be, first of all, we don't know what taxes are going to be when you retire, right? I mean, everybody on this call has a different timeline for when you plan to retire. You might be 5 years out, even shorter than that. You might be 10, 20, 30 years out. And we don't know what the taxes are going to look like in retirement, which, Randy, is why we talked about different strategies to prepare for varying tax conditions or tax situations in the future, right? Is to put protection strategies in so that you have optionality and flexibility for the day when you retire. You can pull from different buckets of money or use a buffer asset, as we discussed. It's kind of addressing the unknown today by positioning yourself for success.
Yeah, and Elise, I thought what you said is perfect when it comes to kind of setting yourself up and wherever you are in your life, whether it's pre-retiree, meaning 5 years, meaning 20 years. But when it comes to planning, everything has to be done with a goal in mind. And that's when it's what's the end in mind, what's the goal in mind. And in this situation, maybe it's the tail wagging the dog, but what's going to help put me in the best position so when retirement does come, I'm in the most comfortable position possible to either pay less taxes, to have as much income as possible, to have as much protection, to have as much of my legacy estate go to my heirs. So it's all based upon what that goal is. And for those pre-retirees, if that's the goal, if taxation is the goal, which we feel is a very important, big piece of the puzzle, that's what we have to start putting a plan together to plan for, to make sure that you're in the best position going forward.
Fantastic. Thank you both. And thank you, Randy, for the great question. Emily, our audience member, Emily, asks, can disability insurance help with retirement income?
Well, it's a good question. Disability does, it's cut off at a certain age, disability coverage. So if you're in your retirement age and become disabled, I mean, there are government programs that can help. But one thing I will say is during your working years, disability insurance is critical. If you were to become disabled and you're putting money aside into a plan, your disability coverage based upon your income, you can put that money, the income that you're receiving, into a retirement plan to help you fund for retirement. So it can make sure that you still can contribute to that plan, that you have something in the future that you can go for. But if you do become disabled in retirement years, that will not be part of the plan, especially for individual disability. But during your working years, this can be a good part to make sure you can still maintain and contribute to those plans.
Fantastic. Thank you. And thank you for your great question, Emily. So I guess to close things off with this final question, apologies, let me just get rid of that one. Final question before we close things off. How can New York Life assist clients in achieving tax diversification in their retirement plans?
So, Jonathan, as you mentioned, we're going to follow up this workshop with a feedback form. And even if it's for a second opinion to ensure that you're on track with meeting your long-term goals, every individual situation is very personal. It's personal based on where you currently have your assets. It's personal based on when you plan to retire, and even what income you expect in the future. So we are happy to continue to provide you with educational information and identify if there are opportunities for you to tax diversify your assets in retirement. And you can indicate that on the feedback form, and we will most definitely have somebody follow up with you.
Apologies, I was muted. Fantastic. Thank you so much. Well, all right, everyone. Unfortunately, we are out of time. Elise and John, thank you both so much for joining us today and giving your insight on how we can lower our tax burdens for the future and capitalize on those insurance benefits. This is such a crucial topic, and we really appreciate having you both join us today. So thank you so much again.
Thanks for having us.
Thank you very much. Thanks for having us.
And thank you to our audience for tuning in and for your great questions as well. Just a few announcements before we end things off today. First off, registration is still open for two of our upcoming events happening this fall. First event, Packaging Chips with Chips Summit in Scottsdale, Arizona. hosted by IEEE-USA and IEEE Region 6, is less than a month away. If you are an industry leader in and around the computer chip manufacturing industry who wants a better idea of how the CHIPS Act will affect your businesses, this summit is for you, but we recommend registering as soon as possible as tickets are running out fast. The second event is the IEEE-USA Innovation Workforce and Research Conference, or iWork for short, which will be holding its next event in Huntsville, Alabama this December 3rd to the 4th. This event offers a chance to meet potential partners from the U.S. federal agencies and learn how you can contribute to the Alabama and Southeast innovation ecosystem. It's an opportunity you definitely don't want to miss. Finally, a word from our sponsor, the IEEE Member Group Insurance Program, powered by AMBA. AMBA offers tailored insurance solutions for IEEE members, including health, life, and disability coverage. Visit their website to explore the benefits and options available for you. If you enjoyed today's webinar, don't miss out on our extensive catalog of presentations available on our website for your viewing pleasure. Remember to like and subscribe to our channels and stay tuned to our social media for daily updates on future live stream updates. Have a great day, everyone.
Your IEEE membership means access to insurance products featuring exclusive group rates, flexible benefit options, and portable coverage that stays with you throughout your career. Engineered to help protect your loved ones and your financial security. For more information, go to IEEEinsurance.com.